Even before I start this video and set the context, let me thank all the viewers who have been watching my channel on a regular basis. The number of subscribers of my channel has now gone beyond 750. I will request all those who find value from the content on this channel to subscribe to this channel and also to recommend this channel to their friends and those who can potentially benefit from the channel. In this particular video, I am going to take you through NISM Investment Advisor Level 1, Chapter 15, and this particular chapter is about portfolio construction process. In this video, you are going to come across 40 quiz questions on different subtopics of this particular chapter. So let me take you through what are the subtopics of the chapter. So you can see here very clearly that the list is very long and it covers multiple topics such as asset allocation decision, steps in portfolio construction process, life cycle of investors, asset allocation decisions, and so many other things. So one chapter itself is very diverse, and this calls for creation of multiple questions on this particular chapter itself. No wonder I have decided to create 40 questions. These 40 questions may not be sufficient enough to cover nuances of all the topics here, but I'm sure they are going to give you a broader feel of what to expect in this particular module. So with this, I am going to start with the questions one by one. First, take you through the question and then share answer for that particular question. So here is our first question. Which of the following significantly influences the performance of investment portfolio in the long run? Well, there are multiple factors which all of us know, right? But there is one very important factor which makes an influence on the performance of investment portfolio, and that is asset allocation. There is nothing like asset allocation. So it's very simple. If you have done asset allocation properly, then you have kind of taken care of 70 to 80% requirement of creation of investment portfolio. So the answer for this particular question is A, asset allocation. Other factors such as market timing, liquidity are not very material here. Market timing may have some weightage, but not significant enough to alter the performance of the investment portfolio. Let us move to question 2, which is an dash 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 is defined as a collection of securities that have similar characteristics, attributes, and risk return relationship. Needless to say, the answer is asset class because asset class is a collection of securities. When we talk about asset class, we may have equity as an asset class, and there could be multiple securities within equity, such as common equity, preference shares, warrants, etc. Similarly, when we call fixed income securities an asset class, we may have different variants of bond within that. So, asset class is a collection of securities that have similar characteristics, attributes, and risk return relationship. Portfolio may be made of completely different kinds of securities, so portfolio would not fit into this answer. Basket is a very generic term. An index is a number which measures change in set of value over a period of time. So, as I said in the beginning, our answer is asset class. This takes us to quiz 3, which is it is dash 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 is the most relevant factor in reaping the benefits of risk diversification, that is reducing the portfolio risk. So, when we talk about risk diversification, beta, standard deviation, and variances are measures of risk. They are not measures of diversification. So naturally, the answer is correlation. And correlation is a very important factor in Harry Markowitz's portfolio risk model, if you have read. So it's the correlation which would be the answer here. Let us move to the next question, which is question 4. Which of the following is not true about correlation as far as investment is concerned? So the first question that we just saw was about the concept of correlation. Here we are kind of evaluating four different statements and seeing which one of that is not true. The first statement, correlation among asset classes returns can and do change over the time and also in different economic situations, which is very valid and true because correlation between gold and equity can change. Correlation between, say, equity and bonds can change, right? So it may change over a period of time, which is there's no denying the fact. Correlation ranges from +1 to -1 or -1 to +1, the way you want to say it. So that's also a fair statement. A value of +1 -1 indicates a perfect positive negative correlation between two variables, which is also correct. So invariably, this is incorrect. So the last one which we see here is incorrect. This one, this particular one, apologies for this. So if the correlation between two assets is zero, then the risk involved is negative. It's not that way. In fact, the correlation must be negative and perfectly negative. So let us move to the next question, which is about which of the following is the first step in the process of portfolio management. So portfolio management undergoes a series of steps or processes, which we all know, right? There is no rocket science over here. So what should we do as part of the first step? So we can see there are multiple options like portfolio measurement and evaluation. I mean, that can definitely not be the first option because unless you create a portfolio, how will you measure and evaluate it? Construction of portfolio after taking into consideration policy statement and financial market forecast, which is also definitely a subsequent step and not the first one. So if you look at the statement carefully, development of policy statement for the portfolio naturally becomes the first answer. Study of current financial situation and forecast of future trends come later. So the answer here would be A. This takes us to question number 6. And let me tell you that all these questions that I have framed are completely taken out from the chapter. So I have read all the paragraphs, all the sentences in the chapter and tried to create these questions so that they can benefit you. Question number 6 says, which of the following is not an element in portfolio management process? So when you do or when you manage portfolio, there'll be multiple steps that you take. Planning is definitely one of the key element. Execution is very important. So is evaluation. So diversification is something which we cannot put here. So diversification becomes that option. Diversification is basically, you know, allocating assets to or allocating investments to different assets. It's not an element in the process. It's more of an activity. We move on to question number 7, and this question number 7 needs us to read the entire question. So investment policy statement serves all the below mentioned purposes except one. Identify the exception. So if you are making investment policy statement, which is IPS, what all things will it cover or serve? So it enables investors to have realistic return, risk return, or realistic return expectation from the investments. That's fair. It enables portfolio manager to make effective investment decisions, which is also logical. It helps in maximizing return for a given level of risk. Now, this is contentious. This is not true actually. The last statement also, it protects the investor against portfolio managers inappropriate investment decision or unethical behavior. That also is correct because once you put a policy statement, the portfolio manager is bound to follow that particular statement. Question 8, which is a straightforward one, which of the following can draft investment policy statement? Can it be investor or should it be investment advisors? In fact, both of them can do that. As an investor also, you can have your investment policy statement, and that's why the answer here is either A or B. Ninth one is, which of the below mentioned aspects should investment policy statement specify? See, investment policy statement can specify multiple things, right? Which are the relevant ones? That is what we are talking about. So, well, investment policy statement can talk about investment objectives, goals, constraints, risks, all those factors. but it would be great if it includes the following factors, which is investment objective, goals, constraints, preferences, and risks. So essentially, if you are including all these five factors, you are kind of making a very, decent investment policy statement or very acceptable policy statement, right? We move on to the next question. Which of the below mentioned statements about IPS is not true? Now, IPS stands for Investment Policy Statement. Let us evaluate the options. IPS forms the basis for strategic asset allocation, which is essentially an interaction between investors' risk return requirement and expected investment return. This is completely true. IPS is the roadmap that guides the investment process, which is definitely true. Development of an investment policy statement is the key step in the process of portfolio management, which is even, or rather extremely or totally valid. IPS once drafted should always remain same till the time investment objectives are not realized. No, this would be a blunder. So we cannot afford to do this. We need to modify the IPS. IPS is not, any holy document which cannot be modified, right? So this is the answer. Question number 11, dash dash dash, has inverse relationship with return. We must know one thing very clearly, that shorter the period of investment, more is the liquidity. For instance, money market instruments are much more liquid than real estate or bonds or any other instruments that you have, because you can realize money really faster. There's a depth in the market. So shorter the liquidity, uh, you know lower will be the return, right? So if you see here, your returns are lower, but when it comes to when it comes to liquidity, liquidity has inverse relationship with the return. So basically, if the liquidity is high, your returns would typically be low. That is what is the meaning of this statement. So we'll go with liquidity. Liquidity and returns have inverse relationship. Let me reiterate. If liquidity is high, then returns are typically less. Risk and return have kind of positive relationship. We often say higher the risk, more is the expected return. Diversification does not have inverse relationship with return, because diversification is more focused on risk mitigation. This takes us to the next question, question number 12. Which of the following mentioned is the right combination of reasons for which investors invest? So as an investor, I would invest for preservation of capital, regular income, and capital appreciation. So the answer becomes this one. Okay. So quiz 12, this is A is the answer. Other options are also not irrelevant, but we will need all these three options basically for the purpose. So the answer would be A. Which of the following would generate periodical income, which means you will keep on getting some income from them? Dividend paying income is periodic, interest paying income is periodic, but investments in zero coupon bond will not get you periodic income, because zero coupon bonds are the bonds which do not pay coupon and they mature after certain number of years. So the answer is C in this case. Which of the below mentioned or is not linked to liquidity requirement? It has not been properly framed, so apologies. So which of the below mentioned is not linked to liquidity requirement? So emergency cash is something which is linked to liquidity. We, in order to ensure that there's cash available, we should take care of our liquidity requirements. We keep emergency cash. Near-term goals is definitely linked to liquidity requirements, because for near-term goals, you basically keep your money in what is called as liquid assets. Investment flexibility, you need some money. When markets are down and things are not that well, you will like to keep some cash, some liquidity so that you can use it. Long-term fund requirement is not directly linked to liquidity. So our answer for this one should be D. This takes us to question number 15. Inability of an individual to sell or purchase of securities on the basis of information that is not publicly known is basically called as insider trading. What is insider trading? Insider trading happens from unpublished price sensitive information. So this will not fall into tax constraint, not fall into liquidity constraint. This will actually fall into regulatory constraints because you are not supposed to do insider trading. Question number 16 and dash 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 is a broad outlay of type of securities and permissible instruments to be invested in the portfolio by the portfolio manager for the investors, taking into account factors specific to investments and securities. So this is called as the investment approach, not diversification, regulatory or taxation approach, straight away investment approach. Question number 17. Under the liberalized remittance scheme, all the resident individuals, which are basically Indians staying in India, including minors, are allowed to freely remit up to $250,000. This is as per FEMA and FEMA guidelines. So you can take $250,000 per financial year for any permissible current or capital account transaction. Question number 18. Which of the following cannot be categorized as idiosyncratic concern of an investor? Now, what is idiosyncratic? This is something which is very unique for an investor. It cannot be generalized for all the investors, right? There could be some common concerns like risk, return, liquidity, taxation are common concerns. Idiosyncratics are slightly unique, right? So an investor is willing to invest in a company which is selling environmentally uh, harmful products, actually unwilling to invest, which is very idiosyncratic because some investors only will go for this. An investor owning stocks of companies she's working with, reluctant to sell the same even when it is financially prudent, even when it is financially prudent due to emotional attachment. So both of them will fall into idiosyncratic concern of investor. None can be actually excluded. Question number 19. Which of the following is not an example of social factor in ESG? So ESG is basically made of three sets of factors: environmental, social, and governance factor. So within social factors, you have many sub items. Workplace safety is one of them. Community development is another. Human rights is also there, but clean technology adoption has to do with what is called as the environmental factor. So now we will be completing after this 20 questions. Okay. That is like we have reached to the half of this particular video, not essentially in terms of time, but in terms of number of questions. So which of the following sin areas, okay, would ethical investing typically avoid? So sin areas are something which are not very good, right? They need to, that's like someone would like to avoid it. So gambling, yes. Alcohol, yes. Smoking, yes. So the answer becomes all A, B, and C. 21st question, dash 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 has a high emotional priority. For long-term investments that you make or even medium-term investments that you make, they are to be achieved over a period of time. But your near-term investments have very high emotional priority. For instance, you have to go out for a vacation, an international trip that you have to make, or something that you have to buy immediately in the days to come. Okay, so near-term high priority goals have an emotional attachment to that or emotional priority to that, right? So we have to fulfill that, on a priority. The next question is quiz 22 for dash dash dash. A diversified approach utilizing several different classes of assets is usually preferred. So if you have long-term high priority goals, you like to follow a diversified approach utilizing several different classes of assets is what you will need. So we are done with 22 now. Move on to question 23. The difference between value of assets and the liability for an individual. We all know it cannot be savings. Savings is difference between income and expense. Investments, it cannot be that also because investments is a part of savings that you put for productive purposes. Wealth also cannot be the answer. So obviously, the simplest possible answer is the net worth. So we move on to question 24. Which of the following are the basis for classifying investor personalities by Ballard, BL, and Kasser model or framework, you can say. So we'll call it as BB, and K, right? So is it level of confidence or is it just method of action? No. In fact, it is both of them. So we go with the answer both A and B. And I will request all the participants to go through this particular model in detail, spend some time. You can at least expect one question here. The four categories of investors here, which about whom we will talk, the guardians, the individualistic, the adventurers that you have, right? All those investors, and obviously, that's only three. What we have as the fourth one is what we can see here as the celebrity. So what's the answer here? Which of the following personalities defined as the people who are willing to put it all in one major bet and go for it as per the BBK model? They're called as adventurer. It's the statement itself is giving a sense of adventure, right? So they are adventurers. That's your answer for this particular question. We move on to 26th question. Which of the following types of personalities go for investment advisors as per the BBKN model, and they are called as celebrity? So celebrity are not film stars and cricketers essentially. Celebrity has a definition in the framework. So you need to go through that to understand it. Let us move to the next question, which is question 27. They are the most difficult investors to deal with because of their own confused beliefs. Which of the following personality does this statement signify? So the statement signifies someone called as celebrities. So celebrities are there, and we need to know that this is the answer here, right? So let us go to question 28. And the question 28 is they are often contrarian investors because they sit back and think about where they want to go and which investments make good sense. They are called as individualistic. So all these types of investors, as I have said already, adventurer, individualistic, guardian, celebrity, you need to really look at all four categories of investors, their trait, make a note, and then go to the exam. You would be kind of confident that you will at least get 1 mark there if you have one question. If there's a case study, then you can even secure marks in that, right? Let us move to the next one, which is 29th, and are the people who are cautiously trying to preserve their wealth. Somebody who is cautiously trying to preserve the wealth can fall under only one category, guardian. Guardians are the one who anyway, protect you even in your life, right? And they do protect their wealth also when it comes to investments. We we go to question 30, and it's a really long video, but your patience for this, and I'm sure you will be, able to do well if you follow all these 40 questions. So 10 more to come after this. This group of investor is a relatively balanced composite of each of the other four types of investors, which are celebrity, adventurer, individualistic, and the guardian, right? And by implication, a group willing to be exposed to medium risk. They are nothing but straight arrow investors, right? So we moved, completed 30 questions. We moved to 30th one and completed this also. 31st, which of the following category of personalities are definitely not interested in volatility or excitement, right? So these are the investors whom we call as the guardian investors. They're not interested in that, correct? This takes us to question 32, which is now we are talking about phases of investments. All previous questions, I mean, around 7 to 8 questions that you came across, they were about BBKN model. Now we have moved to the stage where we are discussing about phases of or the life cycle for an investor, which may goes different steps, the gifting stage, the accumulation stage, the spending stage, and all that, right? So this is defined as the period when living expenses are not covered from earned, but from accumulated assets, such as investments and retirement corpus. We call this as the spending phase, not the accumulation or investment phase, right? Neither is it gifting phase. Question number 33. In this phase, high capital gain investments are balanced with some lower risk assets. Which phase is this? And this is what we call as the consolidation phase. You are balancing things out here. You are consolidating the wealth that you have created. Let us move on to question 34. Why is it that capital market forecast is needed in the portfolio management process? That's very relevant. Is it for identifying investment objectives or tax constraints or liquidity constraints? Obviously, no. So why is it needed? It establishes the expected risk return opportunity available to the investor. So that's your answer for 34. 35th question. Which of the following is not true about benchmarks? And we know that portfolios which are created are mapped against the benchmarks. So which of the following is not true about the benchmark? So benchmarks have many characteristics, many traits. Let us look at this. So a wrong selection can paint a completely different picture, which could lead to a wrong investment decision. Absolutely correct. A benchmark once selected should also be reviewed on a regular basis. That's true. A debt portfolio too needs the right kind of benchmark. There's no doubt about that. That represent the nature of investment made, and benchmark should have zero systematic risk, which is incorrect. So our option here with respect to not true about benchmark is this one. We move on to question 36. I hope you are enjoying this journey with me. Please do not forget to subscribe to my channel and like this video. Which of the below mentioned risk could be a criteria for selecting key criteria for selecting debt portfolio? So you can definitely consider strategic, reputational, and operational risk, but what should matter is the credit risk. Credit risk is the risk which gives us an idea about whether the counterparty would default or not. So let us move to question 37. Which of the below mentioned statement is true or rather are true? A strategic asset allocation is the long-term asset allocation decision, correct? Tactical is short-term. In tactical asset allocation, portfolio manager time the market. With this takes us to the option D. Basically, all three statements are correct, right? So it should have been is, are, I agree, but all three statements are correct. Which of the below mentioned statement is true? Strategic asset allocation decisions involve time in the market, and tactical is for timing the market. Well, such a nicely crafted statements. So we have no option but to say that both 1 and 2 are correct. Okay. Now, quiz 39. Which of the following is not cost associated with the rebalancing of portfolio? You pay research cost, pay taxes, because when you buy and sell, there is a tax applicable, you pay brokerage, but opportunity cost is more of a notional thing, so it is not paid. So that's the answer. And this is the last one. Which of the following is the key reason behind portfolio rebalancing? Change in the price of assets. Yes, that's the reason. Investors' goals and preferences. That's also the reason. Change in risk tolerance. That is also the reason. So what do we have as the answer? All of the above. So I have taken you through 40 questions, and this takes us to the end of the video. Please do like my channel. Do not forget to subscribe to it and share this video with your friends who will definitely be helped if they are preparing for investment advisor level 1. Thank you so much and hope to see you in some other video soon. Thank you.